Adam, so the Peterson has been actually very actively working on this topic of inequality, and you personally contributed to this debate in various occasions. So what is the scope in practical terms for monetary policy making to take inequality into account, given a typical mandate? Do you think that is this feasible, or central bankers are moving in the right direction in that aspect? Adam?
Thank you, Felice, and thank you again for your partnership with David Wilcox and our team here in creating this series of events. I think it's great to start with mandates because it's a good wake-up call on political economy of central banking. And Marcus also mentioned mandates. And I did some research, which is now old but still relevant, that mandates actually have almost no predictive power for the behavior of central banks. So the example I always give is that the Swiss National Bank had some incredibly detailed contingent mandate that almost got into chocolate prices. And yet it had basically the same behavior for much of its history as the Bundesbank that had, a very simple price stability target. Similarly, people who've done Taylor rules and various reaction function estimates for central banks find a lot more similarity than what the mandates would tell you. So I don't want to suggest that legal mandates don't matter, that they are very important, but in practical terms, what we don't need to get too caught up in the language of mandates. What I do think is important is that central banks recognize, as I think they mostly do, that they are independent through the tolerance and the political environment that surrounds them. There is a tendency, going back, that I've been writing about for more than 25 years, to sort of assume that central bank independence was this gift from God or from Ken Rogoff, that you just, it's a solution to a problem, which is the inflation bias and time and consistency, and you just do it and you're done. But that turns out to have been false in multiple senses. One sense is, of course, that the Phillips curve, the trade-off between inflation and unemployment, wasn't vertical in the short term. It does matter, whether through scarring, through longer-term lags, through slowly adjusting labor markets. It does matter what your course of monetary policy is for unemployment. But second, that the issue of independence, just as we're seeing with the Supreme Court in the US, just as we've seen with a number of other institutions, it's constrained by the political background you have. You don't make a decision that's going to undercut your legitimacy. And so one has to have more of a realistic view that it is about dialogue with the public, with the elected officials, whether it's the European Parliament, the US Congress, whoever, and with public support. And that unfortunately or fortunately, that's just the reality, that there's not going to be some legislative fix. There's not just going to be you choose your regime and it's an optimal regime. It has to be a form of ongoing dialogue. And that, I also think, is part of the problem, or not problem, but part of the misconception of inflation targeting, which got picked up, as you know, starting roughly 30 years ago and became the dominant factor in the dominant regime. And it was rightly criticized by some people, or not rightly, but understandably criticized by some people as too obsessively focused on inflation. And because economists tended to focus on the target, not the inflation definition. Whereas, at least in my view, inflation targeting was about increasing transparency and getting you to some midpoint between rules and discretion. And so it was part of an ongoing dialogue, and that was how I interpreted the Bundesbank's success, contrary to what a lot of people perceived. So what does that mean for redistribution and inequality? Let me try to conclude with that. So I think we can return to this, but I think the moves that have been made, in particular by the Federal Open Market Committee at the end of the summer, by some other central banks doing reviews to say, we were wrong, or we had gotten too obsessed with the preemptive inflation trade-off, with needing to get ahead of inflation. And so as you phrased it in your question, Felice, the focus on full employment is important, especially if you do it in an empirically grounded way, meaning you accept the fact that you can't know with precision what U star is, but you know that higher U is better, lower U star is better. And then maybe you should be thinking about things like female labor force participation or differential unemployment rates by race and how the trade-off works. 15, 20 years ago, I raised the idea maybe fighting inflation wasn't a just war, because the idea was you kept sending the same in the US, the same African-American males out to fight the battles every time you raised interest rates. You can't get away from it, but you should realize, like with a war, you don't casually put people out of work. And so this re-emphasis, reorientation towards empirical humility and trying to maximize employment, I think is the right way to go.